A notable shift is happening in the credit card space, and it's coming from a company that has already disrupted how many people think about everyday spending. Bilt is rolling out a major overhaul of its credit card products, highlighted by a 10% introductory interest rate for one full year, available to all cardholders. That detail matters. In an industry where variable credit card interest rates commonly exceed 20%, even for borrowers with strong credit, Bilt's move immediately stands out. Most low rate offers are tightly restricted. They're often limited to new customers, balance transfers, or short promotional windows that reset quickly. Bilt is taking a different approach by extending this introductory rate across its entire existing cardholder base. This isn't just a pricing tweak, it's a statement. Bilt says the new rate structure is designed to make credit more accessible and more transparent, especially for users who rely on credit cards for everyday expenses rather than occasional large purchases. In practical terms, that means less of a penalty for carrying short term balances and more predictability for people managing cash flow month to month. To understand why this is significant, it helps to look at how credit cards are typically priced. Over the past several years, rising interest rates have pushed average credit card APRs to historic highs. Many cards now carry variable rates well above 20%, and in some cases, closer to 30%. Those rates apply regardless of whether a customer is using credit responsibly or temporarily carrying a balance due to unexpected expenses. That environment has made credit cards increasingly expensive tools for consumers, even as they remain essential for daily transactions. Bilt's decision to introduce a 10% introductory rate for all cardholders challenges that status quo. Instead of rewarding only new signups, the company is effectively resetting the cost of borrowing for its entire user base for a defined period. From a consumer perspective, that provides immediate relief. Lower interest rates reduce the cost of carrying balances, making it easier for users to manage expenses without falling into long term debt cycles. For people using credit cards as part of normal budgeting rather than emergency borrowing, that difference can be meaningful over time. But this move also reflects broader changes in the fintech landscape. Competition among financial technology companies has intensified. Rewards alone are no longer enough to differentiate products. Cashback points and perks have become standard across the industry. As a result, fintech firms are increasingly competing on pricing, flexibility, and transparency, areas where traditional banks have often been slower to adapt. Bilt's overhaul fits squarely into that trend. Rather than positioning itself solely as a rewards focused card, Bilt is emphasizing cost of credit as part of its value proposition. That's a notable pivot in a market where many cards encourage spending but offer little relief when balances carry over. It also aligns with how Bilt has approached its brand more broadly. The company has built its reputation around integrating credit with real life financial behavior, particularly for renters and everyday spenders. Extending a lower introductory rate to all users reinforces that philosophy, signaling that the product is meant to be used responsibly, not just accumulated for rewards. That said, experts caution that introductory rates always come with conditions. While a 10% rate for one year is substantially lower than market averages, it is still temporary. Consumer finance specialists emphasize the importance of understanding what happens when promotional periods expire. Bilt has not yet disclosed what standard interest rates will apply after the one year window ends, and that information will be critical for long term planning. Lower rates can provide breathing room, but they don't eliminate the need for discipline. The key advantage here is optionality. Users who pay balances in full may never feel the impact of interest rates. Those who occasionally carry balances benefit from reduced costs during the introductory period. The structure gives consumers more flexibility without requiring them to change cards or open new accounts. From Bilt's perspective, the move may also reflect confidence in its customer base. Offering a lower rate to all cardholders suggests the company believes its users are relatively creditworthy and engaged. It also indicates a willingness to trade short term interest revenue for longer term loyalty, retention, and brand trust. That strategy contrasts with traditional credit card models, which often rely heavily on interest income from revolving balances. If successful, Bilt's approach could influence competitors. When one major player adjusts pricing in a meaningful way, it puts pressure on others to respond. While it's unlikely that large banks will immediately match across the board lower rates, fintech innovations often shape consumer expectations first, then force broader industry change over time. This announcement arrives at a moment when credit card costs are under increased scrutiny. As inflation, Housing costs and everyday expenses continue to strain household budgets. Consumers are paying closer attention to borrowing costs. Transparency around rates and fees has become a competitive advantage, not just a regulatory requirement. Bilt's overhaul taps directly into that concern. By offering a 10% introductory rate to all cardholders, the company positions itself as one of the more aggressive players attempting to rethink how credit cards are priced and marketed. Whether this becomes a lasting model or remains a promotional experiment will depend on how users respond and how sustainable the economics prove to be. But in the short term, the move clearly differentiates Bilt in a crowded market. For consumers, the takeaway is straightforward. Lower introductory rates can reduce costs and increase flexibility, but they should still be approached with awareness. Understanding timelines, future rates, and personal spending habits remains essential. For the industry, the message is equally clear. Rewards alone are no longer enough. Pricing matters again, and Bilt's latest move suggests that the next phase of fintech competition may be less about flashy perks and more about fundamentally changing how credit works for everyday users.